You know this about me, Kim. My family and lifestyle is more important than having more zeros in the bank account. I'm a family man with businesses, not a businessman with a family.
Welcome back to Kim Daily TV. Today I have a daily double for you. My good friend, my longtime friend, Erik Van Horn, is in the studio with me today. Erik, welcome back to Kim Daily TV.
Kim, it's always fun to be on Kim Daily TV with the Kim Daily.
Well, guys, we have an episode in store for you today. So this guy, he knows franchising from all sides, right? He knows single unit, multi-unit, area developer, franchisor. I mean, he's even been a consultant. He's tried it all. I'm not going to say he has ADD. He can tell you that. I'm just going to say he's an entrepreneur and he loves to try new things and then figure it out and then he moves on. He gets bored. So he's had an awesome success with a brand called Sola. I mean, he's had success with a lot of different brands, but I really wanted to bring him on into the studio to talk about his experience in selecting a franchise. Like, what does he look for? What are the criteria of the business when he's thinking about his next move? And who does he bring into the project? How does he select the people? Does he start with the end in mind? Like this particular business, I think he built to 12 locations or so, and then he sold it. So, Erik, let's dive into the conversation right there. When you decided, okay, I'm going to invest in this awesome salon suite concept. And number one, you live in like South Dakota or something, and you did it in California. So there's so many pieces of this that I think will make for a great video for educational purposes for people out there who, they think they have to do it in their backyard. I just think you're a wealth of knowledge, and I just want like my viewers to get more of Erik Van Horn. So start at the beginning. Like, how did you pick Salon Suites and Sola?
So yeah, this will be fun, and this will be like what really happened and come full circle with Sola. So I love this, and I love talking about this whole kind of full circle with Sola. And we did buy 12 locations, and we got those up and going, and we had an 8-figure exit on that business, which was fantastic. But it took 5 years to do that. And in the beginning, I met the founders at a conference that you were probably at in Arizona about 10 years ago. And, being around like you and the people that you have access to, like we had access to the founders, and we were sitting at the bar the night before the conference was going to get started. And I knew that this was a very interesting concept, and I wanted to get to know these founders. So that's exactly what I did. I was asking them question after question after question, and they had another drink and another drink and another drink. So I got a lot of really good information. And
Well,
at the
as I
same
recall,
time,
Stratton used to like to drink.
yes, Matt and Stratton, they're known to be hanging out at the bar. And I didn't know that at the time, but it was very valuable for me to get some good info. And at the same time, I was
But let me just
texting.
say, this isn't information that like we have insider privy to. As a candidate in an active investigation, you would have access to exactly the same information. Perhaps not at a bar, but through the course of your due diligence, you would get the information to the answers to the questions. I'm sure that
This
Erik
is
was asking.
not insider information that was exclusive to Erik Van Horn and nobody else could get access to. It was me knowing the good questions to ask them, how to frame them. And, because like I learned from people like you, Kim. So, you just need to know the right questions to ask. And whether it's, can't, like franchisees or the franchisors, the founders, or the corporate staff, like you just need to ask them the right questions. The environment for me was this convention conference at the bar. That was the environment, but the questions are the same that anybody else could ask. At the same time I was asking these questions, I was texting what would be my future business partners. One of them was a friend and already a current business partner. The other two were not business partners of mine, but I had known them and we'd grown up in the same franchise together previously. So I was texting them saying, hey, I'm asking these founders some really good questions. and they were giving me more questions to ask. And by the end of that, I'm like, spending some time with the founders, I thought, you know what, this is a really interesting brand. And so it intrigued us enough to start to go through the normal, typical sales process of a franchisor. But I did it with my business partners, and we decided at that time to buy this together. So we formed the partnership and talked about everything that a partnership entails. And then we decided on how many units to buy, and we ended up buying 12 territories at the beginning, with the plan to open up 12 of those or more. That was like if things go really well. If they go really bad, we'll open up 3 of them and lick our wounds. If things go okay, we'll probably open up 6 and sell the rest. So that's kind of the foundation. We met the founders. We went through the normal due diligence process, and we had a plan to buy 12 locations in the Orange County market in Southern California.
And why did you pick Orange County?
For me, I wanted to be a part of a brand that is in a larger population base. I mean, we're not going to open up 12 Sola Salons in Spearfish, South Dakota, population of 10,000 people. So that was not going to happen. And so I chose that Southern California market because that's where one of my business partners lived, and the other ones were close by. And it was a large market. So I thought, you know what? If another brand comes up, I want to be able to open up in LA or San Diego, or if Orange County was already sold out. So it was kind of strategic from that standpoint to have a number of businesses in California. And that was before I realized California is a horrible place to do business. For it's not as friendly as South Dakota, but it turned out really well for us. But that's the real reason, Kim, is I wanted the opportunity to expand into different brands. So being a guy that lives out of state, I wanted to go to a market where if there's some hot brands, I could continue to buy it in that general area if it's sold out in my particular market.
So the particular model that you invested in, Sola Salons, for those of you who don't know, it's a salon suite, which means it doesn't have any employees, or if any, one.
Few employees.
So Erik, speak a little bit to the model, and then let's talk about like the day-to-day operation. So you're in Spearfish, your partner's there, who's kind of overseeing, and how do you create a growth plan to build out 3 or 6 or ultimately 12 when each unit of this particular business was such a big investment? Do you have all that cash up front, or are you taking that cash as you grow?
So we did not have all that cash up front, and that's why I could have done it on my own and done 1 or 2, or we could do it in a group of partners where we could do more and figure things out and be stronger together than on our own. We decided to do 12 locations. And Kim, I think I want to make sure I answer your specific question, because I can get off on tangents and give more clarity. So what was the specific question?
No, the specific question is, so when you started out, I mean, I think I asked you 2 questions, right? So
I can only handle 1 question at a time.
I have ADT too, because I want to know what
usually ask like 6 questions at a time, but I can handle 1.
Okay, so let's back up, everybody. The specific question was, when you started out with 12, let's just go to that question. How did you fund? Do you come to the table with, like, let's say it's $1 million per location, $12 million? How do you commit to 12 when you might only have enough money to open 2 or 3 or whatever you had?
So we did not have enough money for 12. We knew it had to work. And SBA was financing at the time. Here's the thing, like, you go in with a plan, and your plan's going to have to adjust at different times, whether it's COVID, whether it's a recession, whether the housing market's going crazy or it's going down. There's always things that are outside of your control. But our plan that we had was, let's go in, we're going to use SBA to finance number 1 and 2, and then 3 and 4, and all the way to 12. Well, what happened, we funded 1 and 2 with SBA, and then SBA came back and said, hey, we're not going to do number 3 because SBA thinks it's too passive of a business model, so we don't do passive business models. Now we're like, oh, okay, now what do we do? We use Apple Pie Capital, which is kind of like private investor. It's not hard money lending by any means, but it's not as inexpensive as SBA or traditional lending. So we did that for location 3, maybe location number 4. And then we had some private banks. There's 2 banks that were starting to loan to the salon suite concept, specifically Sola. So we refinanced out of those Apple Pie Capital loans. I think we even refinanced the SBA loans, and we developed location after location between two different banks. And banking relationships were key. Like, you need to understand how the bankers think. You need to have that personal relationship with them, and we were always trying to be ahead of the game with that, because it's expensive. You're fronting $1 million a location, and we didn't have those kind of deep pockets back then to be able to fund 3 or 4 of them cash on our own if we wanted to.
Did you hear what he said back then after his 8-figure exit? Okay, no, I'm kidding.
Wink, wink. Kim,
Yeah.
just to be clear, I have billions in the bank right now. Billions in the bank
Of
right
course.
now.
And you're humoring me by being a guest on my show today. I know.
I'm glad you recognize.
I definitely recognize your amazingness, Erik Van Horn. Okay, so I think another question I had asked you when I went for the daily double question was tell the viewers what a salon suite is. Let's define that, because a lot of people may not realize.
We would go in and we would take 7,000 square feet of retail space, like think about next to a Whole Foods or a Target anchored center. We'd take kind of the worst 7,000 square feet in the particular center, and then we would spend about $1 million, and we would demo the place. We would put in 50 or 40 individual suites for salon professionals. Think estheticians, hairstylists, massage therapists, and anybody that you would find in nail technicians or nail artists or whatever you want to say, makeup people, whatever it is that you find in a salon, you'd find in a Sola.
He owned it. I know the words, but he owned it, guys. He made the money.
Yeah. So we'd have 40 individual suites, and we would rent those out we get paid every week, and we would rent them under 1 to 2 year contracts to all the salon professionals. And they would have a book of business already. So they would leave a traditional salon, come there, be their own boss, have their own business. And it was an easy entry for them to go from working from somebody to having their own business. So that, in a nutshell, is what the salon suite concept is all about. And I'll say this too. I was a Sola Salon franchisee. There's other salon franchises out there, and I have good friends that own other salon suite concepts, and they're really good too. So it's not just Sola that is really good. The others, some are not so good. Others are really good. Kim
I'm
knows
obsessed with this model. My followers, my candidates know, if you can afford a salon suite, you're probably going to get it in your mix, because I mean, who doesn't want a business with these characteristics? It's basically like being the landlord of a mall where all of your tenants are business owners and you collect rent. So you have predictable cash flow, and as long as you're a good landlord, right? These people, they're running a business. So it's not like they're flighty. Were they relatively, I'm sure you have your one-offs, but relatively long-term renters for you?
Yeah, they're typically 1 to 2, but they were under 1 to 2 year contracts. And then if you're a good landlord, like any good landlord, they don't want to leave. And so the key to that business is just being attentive to your customers, who are your tenants, and taking care of them and having the right boundaries in place. So we didn't have a whole lot of turnover, and we had a really solid occupancy. And like, one of the best things about the model is the labor model. Like, we had a district operational manager that oversaw like a full-time painting handyman type person, that oversaw 3 different leasing team members, and then 1 like bookkeeper that did everything for us from an accounting standpoint. That was the team.
Right. And that's really because of the size of his operation. For the average salon suite owner going in operating 1, 2, or 3 units, you might not even have all of that, right? It's a
No, no,
very,
you don't have
very
a
low
full.
labor.
No, you
Right.
outsource everything. It's like I know people that own now, and it's just them. It's a really
Right.
good business that doesn't take a lot of time.
I always
Um,
tell people that my salon suite owners are my happiest franchisees and my best referral sources. People will call me and say, I want Tim's life because I met him on the golf course, and he's always playing golf, and he talks about this franchise that he owns, but like he's never working. I'm
Yeah.
like, yeah.
It's
I'm like, well, you got enough money?
it's true. And I've seen, through the pandemic, I know my salon suite owners and Gerald and Heather, and they were expanding, they were growing, and
Yeah.
they have the coolest lifestyle too. So like I have good friends that own my salon suites, and I know how that is such a it's like my salon suites and Sola are solid concepts, and so I love it when when franchisees continue to expand and continue to grow. That's always a good sign.
It's always a good sign. Reinvest in your money. And really, just this side note, then we're going to come back to your story. I mean, during the pandemic, we watched these companies move out of these big spaces. So the landlords were incredibly generous with build out and TI money, right? To the salon suite franchisees coming in. And legitimately, the salon suite is the answer to a pandemic in the beauty world, because you're taking these professionals out of a big salon with where maybe they're working with 10 or 15 other people and all of their clients, and you're bringing them into a one-to-one environment where they can control that environment, the cleanliness of that, and sanitize that, keeping it safe for them and their clients. So we saw the salon suite world grow through 2020, unlike some other franchise opportunities. Let's go back to your story. So let's talk about this partnership. So I know you were, when I first met you, you were with Liberty Tax, right? Way back in the day. And I know a lot of your close friends kind of come from like your early days at Liberty Tax. So you found these group of people. Like, how did that partnership come together? Because people will ask me, Kim, should I do this in a partnership? And I'm always like, I don't know. Like, I feel like you enter a partnership and now you're not the boss anymore. Like, you're doing this to be in control, and now you're sort of surrendering control. So tell me your philosophy and how you picked the partners, and did it end up being a good thing? Were there some rocky times?
There's usually rocky times in all partnerships. And if you have it laid out beforehand, those rocky times are just you expect them, and there's a framework to work through challenges and disagreements and different philosophies and life changes, and so you just have to have a really good operating agreement beforehand, and that's just in general. With Sola, we had the same mindset. We did not, none of the partners wanted to work in the business. We didn't want to be franchisees that were active in the business. And so we were aligned on the outcome from the beginning. We didn't want to be active in the business. So we started the business and we were all more active than we wanted to be. Like, we all were diving into the first two leases. We were like, taking phone calls and doing all the things we said we didn't want to do. Because we hired a junior level district operational manager and paid him like 60 grand a year in Southern California 10 years ago. And we're like, this is a disaster. Like, they weren't the quality that we wanted. So we were two locations into it, getting ready to open up our second location. And we're like, this isn't going to work. So the partners looked at each other and we said, what should we do? Would we pay someone $30,000 out of our own pocket to take away all these decisions, all these calls that we're on, all the work that we're doing? And everyone's like, yeah, we would pay $30,000 just to get rid of that pain.
Collectively, 30 from each of you.
Collectively, yeah,
Yep.
each of us. So it's 120 grand. So we're like, well, then let's hire somebody for 120, and they'll be the district operational manager. That's really good. And so we went through a 3 to 4 month period of finding the right person, and we're very focused on that. And we came out hiring a guy named Mirko, and he came from the leasing background, property management background. And at the end of the day, that's what this is. This isn't, we were hiring beauty professionals like salon owner or like former salon managers to be the manager, and it wasn't the right fit. So we hired Mirko. He's used to dealing with landlords. He's used to dealing with attorneys. He's used to dealing with CPAs. He's used to doing all of that stuff. So we hired him, and like our lives changed. Like, he was doing it all. We went from reviewing these leases with the attorneys all the time to getting an executive summary and him saying, hey, this is where we are. This is what we've negotiated. Any questions, any suggestions? And once a week, we'd be in a meeting, and he just kept making good decision after good decision. We kept giving him more and more leeway to where at the end of the day, we'd meet once a year face to face, and we would have meetings once a week for like an hour. And we would say like, oh my gosh, we should give him some equity, we should pay him more, we should do something because he's too good, he's too smart, like he's not gonna stick around as a district operational manager for us. And then we got an email, hey guys, I need to talk to you about something. And we all just got into a text thread, me, Dan, John, Ryan, we're like, this is it. Like he knows now how good he really is. We're in trouble. And and he said, hey, I love working for you guys, but I'm going to do this on my own. I'm going to open up my own Sola in a different market, so I'm not competing against you guys. But it's been fun. I'm out of here. And he didn't quite say it like that because we had a really good relationship with him. He's like, I will do whatever you guys need me to do to stay on however long to help you through the transition. And it was at that time when Sola was, we were getting some pressure from them to develop faster than what we felt comfortable developing. And so we quickly executed another 3 territories. So now we had 15 territories, and we were in the process of building out store number 11 and store number 12. They weren't built out, they were in the process of it. So we went to them, we're like, hey, we love Sola, we want to buy more, and give us I think it was 1 or 2 year rights to continue to develop the market exclusively. And they said, sure, here you go. And knowing that we were getting pressure from them, but we knew that we either wanted to double down with them or sell. And so the conversation was, hey, we either want to continue to grow really fast with you, and how can we work on that together? Or if you see a better fit for this market for yourselves and to grow with a number of franchisees in this market, then we'd be open to a conversation of you buying us out. And that's how we approached that conversation. And they said, actually, we would like to consider buying you out because we think we can put a cajillion Sola Salons in your little market of Orange County. And we're like, okay, let's talk about selling it. And that was the beginning of that long sales process to sell to private equity.
The franchisor initiated, kind of pushed you into that position to sell it because they knew they could divide the market up way, further. But ultimately, you sold the business to private equity, not to the franchisor, or the franchisor was backed by private equity.
The franchisor, and we had a hint at the time, but we didn't know it, was in the process of selling to private equity.
I got you.
And so we were originally going to be selling to the franchisor, but they knew that we are eventually going to sell to private equity. So the transaction was announced. Sola sold to private equity. We had the buyer as the private equity company that bought, and so then it was just even a deeper dive into our financials and this, that, and the other. And Mirko did all of that. He did all of that. And here's another kind of important point along those lines, Kim. We set up the business, from location number 2 to 12 with Mirko at the head, founders not involved. So private equity comes in. They could say, okay, these guys aren't actively involved in the business, so the books were really clean, knowing that we weren't actively involved with it. They knew Mirko would stick around for 6 months to, on retainer to help them through the transition, and they had somebody else that was going to take his place because these people were used to being managed by an employee, not by the owner. So we built it to sell. We built it for lifestyle, and then building it to lifestyle is also building to sell. And
Yeah.
so we had the enterprise value of that company was higher because we paid Mirko a little bit more than we were paying the junior level guy, and we made a lot more money because of it. And we had a much better lifestyle because of it. All of us partners did. So
Right.
we eventually sold out to that same private equity company, and I just had some conversations with that same company a couple weeks ago at an event. So it's kind of fun to come full circle with that.
It's such a fun story. You guys see why this guy is gold? So, what's next for you? Like, I know you've already moved on and you're doing many other things, but in the beginning of this call, you mentioned you're raising some money to go do another multi-store play. Like, that's kind of your thing now. Are you looking to replicate, like build, raise some money, build, and then flip it?
I You know this about me, Kim. My family and lifestyle is more important than having more zeros in the bank account. Like, I love making memories with my family. I'm a family man with businesses, not a businessman with a family. Like, that's at the core of who I am.
That's
So I've
awesome.
gotten a lot clearer in recent years on aligning with people that are aligned with that vision. And some opportunities I've let go, some because there wasn't alignment there. And I've been at the place where I was hustling and working really hard. So I'm a fan of that, and I've done that, and that's necessary at different times. But I've just chosen to not have extra zeros and have more time with my family. And it might be just for a season. I don't know. I take it a year at a time. But right now, I love passive investing. I love investing in cash flow deals, and I do a lot of different deals outside of the franchising world. I've learned a lot about passive investing. I've made some really good decisions there that have had a fantastic impact on my my bank account and just how I'm able to live life. But I've also seen how that is not really normal in the franchising world. So an example of that is I've got a couple friends. I got a current business partner of mine now. We're very much aligned. We see things the same way. We have two other friends that are in a business, a franchise that is successful, meaning they are making money in their locations. They are breaking even in 1 to 2 months. They know what they're going to make year number one in cash flow, year number two, year number three, because they've done it a handful of times, and they're on the inside of the brand, so they know that this isn't just a unicorn story of a couple franchisees doing really well. So we're in the process of securing about 12 locations in that franchise brand as a franchisee entity. And they know Erik doesn't want to work in this thing very much at all. So I will help raise money. I will help make introductions. I will help with those types of things. And they want to get the lifestyle that I have. And so we're aligned with that. And so if they didn't want my lifestyle and they wanted more equity, they wanted to continue to hustle, they would get more equity as a result of that. They do want my lifestyle, so we're going to pay them per location as a management fee. So that way they can be making really good money for each location while they're providing that service. But also, if they decide to step out and have more lifestyle, they can hire somebody and at a two, three, $400,000 position to go and do their role that they were doing. So there's got to be alignment. So and with that one, we're looking at doing a friends and family raise. There's different ways to raise money, but we're going to be doing this one through friends and family. That way, I'm not putting in probably more than 10% of the total capital. My risk is really limited. The operational people will have more risk in the deal, meaning signing on leases, signing on franchise agreements, and things like that. But I want to see more of that in franchising, because a lot of people want to get into franchising and they don't have the opportunity to actually own, or they want to take a step. And maybe some of the people invest in something like that, and then they were like, "Oh, I want to do this on my own," because you will make more money doing it yourself than you will being a passive investor in anything. Franchisees will make more money in this particular brand just doing it themselves with one location than being a passive investor. So that's happening. I'm an advisor to different franchise brands out there. Like Dirty Dough Cookies is probably the one that's the most well known. Bennett over there, I'm an advisor. I have equity. It's one of my portfolio brands. And I really enjoy having advisory shares, advisory services to brands like that. And then, over at this other group that I'm a part of, we're getting much deeper into advisory, strategic advisory, down into the weeds to help brands really grow smart and avoid the mistakes. But that's putting our time and attention into the brand. It's me and a couple guys that and I don't know how much we want to get into that. And maybe that's for a later day. But I'm just having a lot of fun, Kim.
I
Having a
can
lot of
tell
fun
you're
doing
having
what I
fun.
enjoy.
It's awesome. You know what? The best thing you said is that I want to say it the way you said it. I'm a family man who owns businesses, not a businessman who has a family. Like, I want to end on that note, because that is what I'm selling all day long, right? Whether you're doing it by yourself or you're doing it, investing in a franchise for your own future or in a partnership, the idea is that you're setting up your life for full control. That's what Erik has done. He's created a way through multiple steps. He didn't just get to this level. He started at a different level. He's, like he said, he's hustled, he's done the work, he's figured it out. And now he's surrounded by people and he has the money to be able to put himself himself in a position where he's in play, but it's not his time, it's just his money. If this story has inspired you, you're ready to take the first step or the next step, and you think that it is a franchise investment, you know that I would love to be your daily coach. Please follow the email on the screen right now or email me directly at inquire@kimdaly.tv. Erik, thank you so much for being our special guest here today at Kim Daly TV.
Thanks, Kim.
You're the best. To the rest of you, I'll see you next time on the next episode.